Did you know that there is a method to invest in mutual funds that will provide the best returns in the future? And there is a method to select the best mutual funds that will constantly generate good returns every time. All this information that will help you get maximum returns on your investments is captured in this video. So stay tuned to learn them. In the process of selecting the best mutual funds, we usually do two things. Firstly, we check the star ratings of mutual funds agencies like CRISIL. Secondly, we check which funds have provided the highest returns in the past 1 or 2 years. We start thinking that the fund which has given the highest return is the best. When a fund receives good ratings on the basis of past 1 or 2 year performance, many new investors invest their money in it, making it challenging for the fund manager to manage such a large new corpus. In a bull market, when stocks become too expensive, intelligent investors do not purchase them. However, the fund manager cannot do that, even if they want to, because the mutual fund law says that mutual fund companies cannot keep more than 35% of the investor's money in cash form. In such a situation, fund managers often have to compromise on the quality of the stocks. And therefore, all good performers and/or 4-star/5-star rated performers may not give high returns in the future. Now, let's talk about why we should not select a fund based solely on its past 1 or 2 years performance. Sometimes, a fund generates 30% or 40% returns in any particular year, making us greedy, and we purchase that fund in expectation of similar returns in the future. Let us understand the problem with this approach through a simple example. In car race, one driver's approach is to drive as fast as possible, with no focus on safety and no caution on accidents. In such a case, in the middle of the race, he faces accidents and is unable to complete the race. But one positive in this approach is if he completes the race, he will come first due to his speed. There is another driver whose focus is on safety. His ideology is to finish first. You have to first finish. If you want to win the race, you have to first complete the race. So his focus is on safety. If the road is curvy, he slows down. If someone is ahead, he carefully overtakes and increases his speed only during the right opportunity. Why am I giving this example? In the mutual fund industry, many funds take too much risk. In their past 20 years track record, for 15 years, they remain as bottom performer. They suffer significant losses in those years due to their high risk appetite. But in the remaining 5 years, they generate good returns due to taking high risks. In the past 2 or 3 years, many funds have taken too much risk, and as it was a bull market, they ranked 1SD/2ND for those years. The problem with these funds is that even though they have generated good returns in the past 1 or 2 years, there is no guarantee that these high-risk funds will give favorable returns in the coming years. These high-risk funds suffer significant losses when the market is down. So it can be dangerous to get attracted to a fund solely based on its short-term returns. These are the 2 things we should avoid. Now let's talk about the 4 things which will help you in selecting a good fund. Track long-term record. For any fund, track its past 10 years track record. It is not necessary that the fund should be first or second every year. Instead, we should check whether the fund has remained in the top 20% in its category for each year in the past 10 years. A good fund cannot be winner every year, but it should remain above average in all the years. This will ensure that the fund is not taking extra risk to become leading performer in any particular year. Thus, it will not perform too bad if the market corrects itself. Track the fund manager's performance, not fund performance. It may happen that a fund has performed above average in every year of past 10 years as per the first criteria discussed. Then should you immediately purchase that fund? Is selecting a fund that much easy? Definitely not. Let us understand this with an example. West Indies was once a legend cricket team. They won the first 2 Cricket World Cups. In 70s and 80s, their team was best in the world. So, overall their track record is very good. But will you consider West Indies the best team in today's time, seeing their past track record? No. This is because times have changed. In similar terms, if a fund has constant track record in past 10 or 15 years, then whether we should invest in that fund depend on the fund manager. The past performance does not have any significance if fund manager has changed recently. We should always check whether the same person is managing the fund who has given consistent returns in the past 10 to 15 years. This is because a fund is not good or bad, instead a fund manager is good or bad. How do we determine whether a fund manager is good or bad? First, the track record of the fund should be consistently good in all those years in which he has managed the fund. Second, if a fund manager manages 5 funds and if out of 5 only 1 scheme has performed well and rest 4 have performed badly, I will not consider that fund manager to be good.
It may happen that if you are doing 5 things, you perform well in 1 due to sheer luck. If 3 or 4 out of 5 do well, I will consider that fund manager to be good and I can trust that person for my investment. Next method is track on of the fund. Now we see a fund's track record as well. The fund manager is good. The same fund manager is managing the fund for past 7 to 10 years. The next thing we will focus is AUM, that is, assets under management. We must track how the AUM has changed in recent times. Has a lot of money flowed into the fund in the past 1 or 2 years? It may happen that initially when AUM was low, it was easier to find quality stocks. Now, if suddenly a huge inflow of money happens in that fund, I will avoid that fund. During such times, the fund manager has to somehow invest that money as he cannot keep more than 35% of the money in cash. So he may be forced to buy not so good quality stocks. In such cases, future performance will get affected. Keep in mind, large cap or multi-cap schemes should have AUM below 20,000 crore. Mid-cap schemes should not have AUM above 10,000 crore. Last method is track risk versus return record. We should not only monitor returns, we should also check risk versus return track record. That is because good returns can be generated by taking high risks. But that fund manager is best who can give high returns taking lower risk. Generally, large cap schemes have lower risk than mid cap or small cap schemes. If a large cap scheme has given 15% returns in the past 10 years and a small cap scheme has given 16% returns during the same period, then for only 1% extra returns I will not prefer high-risk small-cap funds. In conclusion, while selecting a mutual fund, it's important to avoid getting attracted to short-term returns or star ratings. Instead, track the fund's long-term performance, consider the fund manager's track record, keep the cost of investing in mind, and choose a fund that aligns with your investment objective. By following these steps, you can make an informed decision and select a mutual fund that has the potential to generate good returns over the long term. Hope you enjoyed watching this informative video and it gave you a new perspective in deciding your next mutual fund SIP. If you like this video,